Hello and welcome to my channel Happy Hours. In my last video, I discussed about the CRAR, about the microfinance, niche bank and PSL, and about the VC model of banking which was launched in the year 2006. In this video, I am going to discuss about the issues of NPA, stages before the NPA, and some important steps taken to control NPAs, which were DRT, JLF, SDR, S4A, and IBC. And I'm going to discuss about the bad bank, deposit insurance in India, and CBDC. So what are we waiting for? Let's jump to the first topic, which is the issue of NPA. Before understanding the issue of NPA, we should understand what is NPA. The full form of NPA is non-performing assets. If interest or installment of a bank loan remains due for a period more than 90 days, then it is called NPA. And before becoming NPA, a loan undergoes the following stages. First is SMA 0. SMA means specially mentioned account. The delay is of about 1 to 30 days. Next is SMA 1, which is 31 to 60 days. Third one is SMA 2, which is for 61 to 90 days. And the final one is the NPA, which is more than 90-day delays. Non-performing assets are loans or advances issued by the banks or financial institutions that no longer bring in money for the lender since the borrower has failed to make payments on the principal and interest of the loan for at least 90 days. By this, we have understood these. Now, let us understand one more thing, and that is the higher level of NPAs leads to distrust among the depositors, and this will further lead to the condition of bank run. Now, we have understood the word bank run. Now, what is the meaning of bank run? It means when the customers of the bank or other financial institution withdraw their deposits at the same time over fears about the bank's solvency. As more people withdraw their funds, the probability of default increases, which in turn can cause more people to withdraw their deposits. And apart from above, there will be negative impact on the balance sheet of the banks. This will reduce the market value of the equities of bank. We have came across another word or concept which is balance sheet. Now let us understand what is balance sheet. Balance sheet is a key way to draw conclusions regarding the bank's businesses and the resources used to able to finance lending. The volume of business of a bank is included in its balance sheet for both assets, which means lending, and liabilities, which means the customer deposits or other financial instruments. The balance sheet is having three components. First is the asset, second is the liability, and the third one is the shareholder equity. Now we have to understand one more thing, and that is the level of NPA, gross NPA ratio, and we are having four members of it. First is the public sector bank, next is the private bank, third one is the foreign bank, and the last one is the scheduled bank. Under the scheduled bank, we are having some more divisions. First is the scheduled cooperative bank, and the second one is the scheduled commercial bank. Now, whenever there is the concept of NPA, previously the scheduled banks they were having the higher level, but now we can see that the PSBs, mean the public sector banks, they are with 3.7%, private bank they are with 1.8%, foreign bank they are with 1.2%, and scheduled banks they have reduced from 11 to 2.8%. These NPA is generated, means this chart is being presented in the month of March 2024 financial strategy report. They are giving by the financial stability report SR June 2024, released in every 6 months by RBI. They are releasing it in the month of June and in the month of December. In June they are giving the report till March data, and in December till September data. These ratio for scheduled banks is the lowest in the last 12 years, as I have mentioned before. Now, I'm going to discuss about some of the important steps to control NPA. The very first step is the Recovery Tribunal. It was introduced in the year 1993 and it was considered to be the landmark as they have created a separate tribunals for the settling of loan recovery. DRTs hear the cases of loan recovery. Their primary purpose is to facilitate speedy and effective recovery of loans granted by banks and financial institutions from borrowers who default on their repayments. The key feature of DRT is juristic DRT handle cases where the loan amount exceeds rupees 20 lakh as of 2020. Next is we are having the Joint Lenders Forum. It was introduced in the year 2014. The forum is a dedicated body of lender banks that is formed to speed up decisions when an asset of more than rupees 100 crore or more turned out to be a stressed asset. But due to certain reason, the RBI removed it. Next one is SDR, which was launched in the year 2015, and the full form of it is Strategic Debt Restructuring. It enables banks that have issued loans to the corporates and entities to convert a part of total outstanding loan amount and interest into major shareholding entity. Now, in the company, now the banks are going to become the equity holder. So now the bank is also going to be a member of that company. But due to certain reason, it was also removed by RBI. Next one is the S4A and it was introduced in the year 2016 and it is known as the Scheme for Sustainable Structuring of Stressed Asset. It was introduced as an initiative to address the resolve and debt issues of corporate sector along with strengthening the ability of the lender to deal with stressed assets. Now, loan restructuring can be done either through a limited loan repayment holiday, rescheduling loan repayments, or lowering interest rates. This is one time restructuring only for borrowers who have been financially impacted by the COVID 19 pandemics. Now, this is also removed by RBI. Next one is IBC, which was launched in the year 2016 and it was known as the Insolvency and Bankruptcy Code. These issues of insolvency are resolved within a period of 330 days. If the time period is crossed, then the process of liquidation started. The Insolvency and Bankruptcy Code 2016 is the bankruptcy law of India, which seeks to consolidate the existing framework by creating a single law for insolvency and bankruptcy. The code outlines separate insolvency resolution process for individuals, companies and partnership firms. The process may be initiated by either the debtor or the creditors. A maximum time limit for completion of insolvency resolution process has been set up for corporates and individuals. For companies, the process will be completed in 180 days, which may be extended for another 90 days if a majority of the creditors agree. For startups, small companies and other companies, resolution process would be completed within 90 days of initiation of request, which may be extended by 45 days. There is one amendment done on it and that was the act in the 2019 which has increased the mandatory upper limit time limit to 330 days. Previously it was for 180 days but after the amendment act in 2019 it was increased to 330 days including time spent in legal process to complete resolution process. The solvency process will be managed by a licensed professionals. These are being trained. These professionals will also control the assets of the debtor during the insolvency process. The court processes the court proposes two separate tribunals to oversee the process of insolvency resolution for individuals and companies. First, the National Company Law Tribunal for companies and liability partnership firms, and the second one is the Debt Recovery Tribunal for the individuals and partnership. So the time limit is 330 days, and the application for insolvency proceedings must be submitted to the adjudication authority. The maximum time allotted to consider the application is 14 days, and on the date on which the insolvency commences, a moratorium is declared, and it remains in the force until the end of CIRF. Now let us understand the new concept, that is the bad banks. It was introduced in the year 2021, and NARCL, National Asset Reconstruction Company Limited, can acquire bad loans of the value of more than rupees 500 crore each. They can divide it into two forms, that is the cash for 15% and securitization receipt for 85%. Now let us understand this in detail. Now let us understand what is a bad bank. Bad bank are set up to buy the bad loans and the other liquid holdings of another financial institutions. For the critics, they say that the bad banks option encourages banks to take undue risk, leading to moral hazard, and even knowing that the poor decisions could lead a bad bank bailout. It is a financial institution whose function is to acquire non-performing asset. Means the non-performing assets are going to be bought by these institutions from other banks or the financial institutions. They acquire the NPAs of other banks, provides a safety net to them by removing bad loans from their balance sheets. By this, the banks are clearing their, or we can say stabilizing their bank sheets and enabling them to lend without constraints. Now, banks sell such assets to bad bank at a steep discount, often 15 to 20% of their value. This helps bank clean up their balance sheet, as I have mentioned before also, and the bad bank then tries to resolve their asset either by reviving or selling in parts to recover the maximum possible value. Now, banks receive 15% of the value of these assets upfront in cash, and 85% later as security receipts. If the resolution extends beyond 5 years, the government pays banks against the SRs. Now let us understand the next concept, and that is the deposit insurance in India, and it was started in the year 1961. Deposit Insurance and Credit Guarantee Corporation DICGC is the wholly owned subsidiary of the Reserve Bank of India, and it provides deposit insurance that works as a protection cover for the bank deposit holders when the bank fails to pay its depositors due to some crisis also. The agency issues all kinds of deposit accounts of a bank, such as saving, current, recurring and fixed deposit, up to a limit of 5 lakh per account holder per bank. In case an individual deposit amount exceeds rupees 5 lakh in a single bank, only rupees 5 lakh including the principal interest will be paid by the DICGC. If the bank becomes bankrupt, the present coverage is deposit of 5 lakh, as I have mentioned, and it is provided by the Deposit Insurance Credit Guarantee Corporation DICGC, as I have mentioned, the 100% subsidiary of the RBI. Now let us understand the last topic for today, and that is the CBDC. The full form of CBDC is Central Bank Digital Currency. It was first proposed in the budget 2022 and 23 by the Ajay Chaudhary Committee. It is being implemented on pilot basis where they were having the two parts, that is the wholesale transactions and the retail transaction, means the e-wallet and e-rupee. The e-wallet is for the secondary market, means which means GSEC interbank transactions, and the e-rupee is for the traders and the customers. Now the first country which introduces it was the Bahamas. US is still trying it. Now, what is the impact in on the bank? And that is whenever there is the e-currency, or we can say the digital currency, then the liability is going to decrease. But the depository rate is going to increase, and process of money multiplier is also going to get affected, and it is going to decrease. Next, if we have to understand the impact on the central bank, there the liability is going to increase. We have to understand why there is a need for CBDC. First, the cost of printing, minting physical currency can be saved. The private virtual currency are unregulated, and the third is the payments are final. No intermediary is required. By this, I'm concluding my video. If you find my video useful, kindly like, share, and subscribe. Thank you.